Now let us see different terms, that is long build up, short build up, long unwinding and short unwinding. What is meaning of long build up? Can anyone tell? Long build up means long positions are getting created. And how can we say long positions are getting created? When open interest is increased and price increases along with increase in open interest. What does it indicate? It indicates that buying is increasing the price of option or future. People are buying and selling at same time. For every buyer, there has to be one seller. In options contracts as well as in futures contracts, this is true. So, change in price indicates whether buyers are active or sellers are active. Who has more power? When buyers are active and building their positions, then there is increase in open interest and increase in prices. They are expecting more upside, so they are adding positions to their winning positions. It can be same people or some new people who are getting interested. Long build up means people are buying, open interest is increasing and prices are increasing. What is meaning of long? Long means buying. Long build up in future means bullish view. Long build up in calls means people are buying call. They are expecting option premiums to increase, and when call premium is expected to increase, underlying is also expected to increase. So view is bullish on underlying. But when there is long build up in puts, what is meaning of that? It means people are buying puts and premiums of put is increasing with increase in open interest. Means people are expecting more increase in put premiums. That means their view is bearish on underlying. Is this clear about long build up? Long build up in calls and futures is bullish view. Long build up in puts is bearish view. Now what is short build up? Short build up means short positions are getting created. And how can we say short positions are getting created? When open interest increases and price decreases along with increase in open interest, it indicates selling is decreasing the price of option or future. People are buying and selling at the same time, and here selling is producing more effect than buying. When sellers are active and building their positions, then there is increase in open interest and decrease in prices. They are expecting more downside, so they are adding position to winning positions. It can be position of same people or some new people who are getting interested. Short build up means people are selling, open interest is increasing and prices are decreasing. Short means selling. So short built up in futures means bearish view. Short built up in calls means people are selling call. They are expecting option premiums to decrease. When call premium is expected to decrease, underlying is also expected to decrease or remain below that strike price, and view is bearish on underlying. When there is short built up in puts, what will it mean? It means people are selling puts. Premium of puts is decreasing with increase in open interest. Means people are expecting more decrease in put premiums and view is bullish on underlying. Now let's come to long unwinding and short covering. What is meaning of unwinding? It is opposite of long build up. In long unwinding, open interest decreases and prices decrease. So price decrease and open interest increases short build up, but when price decreases with fall in open interest, then it is long unwinding. What happens with long unwinding? In long unwinding, people holding long positions are exiting their positions. This may be exit in profit or exit in loss. When open interest decreases and price decrease, it indicates long unwinding. In futures and calls, long unwinding is bearish, whereas in puts, long unwinding is bullish. On the other hand, price increase with decrease in open interest is known as short covering. Here, people who were holding short positions are exiting their positions. Because of exiting open positions, open interest decreases. In short covering, there is decrease in open interest and increase in prices. When there is short covering in futures and calls, it is bullish. But when there is short covering in puts, it is bearish. So long built up in futures and calls is bullish, long built up in puts is bearish. Short built up in futures and calls is bearish, whereas short built up in puts is bullish. Long unwinding in futures and calls is bearish. Long unwinding in puts is bullish. Short covering in futures and calls is bullish. And short covering in puts is bearish. Is this clear? Any questions about this? Now let's move ahead and discuss about open interest. Common notions are highest open interest on call side is considered as resistance level and highest open interest on put side is considered as support level. But why is it so? Can anyone answer this? Because it is said that institutes sell option and retail investors buy option. Large institutions means people with large capital. Options have huge volumes, and in a week even 10 points decay in an option means 500 rupees profit per lot for Nifty. This is about 0.5% profit in a week on capital deployed if it is without hedging. For one lot of option selling, 1 lakh margin is required. So 500 rupees is 0.5%. When hedging is done, capital requirement is decreased. So 0.5% profit in a week is huge profit for institutions who have very big capitals. This is the thought process behind the saying that institutions are selling and small investors are buying. But is this true? Well, large institutes do not deploy full capital on single trade. So even if it is giving return of 0.5% in a week on capital deployed, it does not mean return on total capital is 0.5%. And risk involved is too high because large institutes cannot exit their positions very swiftly. And small value option premiums increase very rapidly when underlying comes closer to strike price. Premiums of these options may increase multifold, and it is not cost effective to manipulate underlying for such small gains. They rather prefer to trade with adjustments and exit loss making positions gradually or keep those positions and build counteractive positions to negate the losses. Institutions know when option premiums are inflated and what is correct time to sell options or buy options. So highest open interest may be rough guide for support and resistance level, but it is not a holy grail. See this table. Here highest open interest on put side is at 17,300 strike. So this is 17,300 strike. Highest open interest is at 73,122 contracts. Now this is significant premium at 17,300, which is 89 rupees, and open interest 73,122 contracts. Now this is significant premium and significant open interest. Strike is very close to current market price. This is slight out of the money option. Now look at change in open interest column. This is change in open interest. This is open interest. This is change in open interest. Change in open interest is 56,950. There is increase in open interest by 56,950 contracts as compared to previous day. And check volume in this strike. This is volume. Volume is highest for today. So 17,300 contracts have highest volume for today, highest change in open interest, and highest open interest in all put strikes. Next highest open interest is at 17,200 put, and next highest volume is also at 17,200 put. Change in open interest is 12,131 contracts. Means people had written 17,200 initially, because of that it has high open interest, but today open interest has increased more at 17,300. People have shorted more actively at 17,300 puts, and 17,300 put has surpassed 17,200 put in terms of open interest and change in open interest. There is one more interesting fact here now. Open interest at 17,400 put is 27,164, and at 17,350 put is 24,248. However, check change in open interest. Both these strikes have increase in open interest, which is more than strikes below 17,300. Means out of the money put open interest has not increased as much as that of slight in the money and at the money put option. What is interpretation of this? People are more comfortable in holding slight in the money put options. People are more comfortable in holding slight in the money put options overnight, and possible up move is expected on next day. After evaluation of put side, let's go on call side. Here highest open interest is on 18,000 call, which is 80,213. Premium is 2.15. Where is next highest open interest? If we see here is 41, 48, 40, 53, 46. So 53,000 is highest open interest at 17,500 strike, and premium is 63. There is change which is positive. What does this mean? Premiums are increasing, open interest is increasing. This is long built up. Here we can check premium is increasing, open interest is increasing. This is also long built up. Same is here. In all call strikes, premiums are increasing with open interest increase. So this is long built up in call side, whereas this is short built up in put side. Short built up in put is bullish on underlying, long built up in calls is bullish on underlying. So prices are expected to increase. People may say that 18,000 is a resistance level because there is highest open interest of 80,000 contracts. What do you think? Is this a resistance level? Have people shorted this call of 18,000 strike for rupees 2.15? If I am a market maker and I decide support and resistance, will I sell options which cost so low and decide to make it as a resistance level? Absolutely not. That's childish. Because in 6 days, decay will be just 2 rupees. But if prices increase rapidly, what will happen? Even if markets close at or below 18,000 on Thursday, and even if options expire worthless, in between if there is huge increase in option premiums, what will happen? It will show big losses. Have a look here what happened on Tuesday. Premium of 18,000 call is 15.25. There is increase in open interest, and increase in change in open interest. Highest open interest is still at 18,000, but premium has increased from 2.15 to 15.25. So if those people who thought that this is resistance level when premium was 2.15, now the premium is 15. It is almost 7 times. So if somebody was selling it for 2 rupees, will they wait for 15 rupees premiums? No, they will not. They will exit much earlier because the loss will be 7 times than expected gain, and this is not a good trading. Smart people do not trade like that. Who will take 15 rupees loss for 2 rupees gain? I guess nobody. Not those who have large money. So here option premium has increased to 15 rupees and it may go on to increase till 20 or 30 rupees as well. Important thing to understand here is larger players with huge money are interested in more premiums and near at the money strikes. They have less interest in farther strikes for current weekly expiry. Premiums are very low in far strikes and any rapid move will show losses which will be more than 4 or even 10 times than maximum profit possible. If option worth 2 rupees makes high of 20 rupees, it is 10 times loss for option seller if that position is open. So huge open interest at small premium options does not mean it is support or resistance. Important points to note in option chain are highest open interest close to at the money strike for current weekly expiry. And then change in open interest in near at the money strikes of current expiry is equally or even more important than total open interest. Volume is usually highest for at the money options. High volume means low slippage and good rapid order execution. Large players want liquidity for their big positions, so they can execute without much slippage. Traders who can bring huge volumes and have power to manipulate markets are more active at the money or near strikes. Now let us see how we can predict direction of underlying from option chain. This method is useful mainly for Nifty and Bank Nifty. Weekly expiry should be used for this purpose. It may not be useful in less liquid option chain of stocks and option chain of indices with longer time to expiry. We can get rough idea of direction for the day or next day by observing option chain. If we understand logic behind activity in options, then we can try to decode hidden message in option chain. Here we can see highest open interest is at 17,300 put, which is at the money put or slight out of the money put. We just discussed this example. Now highest change in open interest is also at 17,300 put, which means maximum open interest has been built today in 17,300 put. What is effect of increase in open interest? Price has fallen by 88.9 from yesterday's price, so it has halved. Here we have seen there is rise in open interest with fall in premiums of 17,300 put, and this is what kind of build up? This is short built up input. Short built up input means puts are getting shorted and put premiums are decreasing. What is meaning of this? View is bullish in underlying. Am I right? Now check highest open interest on call side. Highest open interest in call is at 18,000 strike. It is far out of the money strike and less useful because premiums are not worth selling. So we will check next highest open interest. Next highest open interest is at 17,500 call. This is 53,461. Increase in open interest is 9,389. means around 20% open interest is increased today. And what is effect of this change in open interest or increase in open interest? Premiums have increased by 27 rupees and now they are 63 rupees, means there is increase of more than 40% in premiums, and there is increase of more than 20% open interest. What is this indicating? Call premiums increased, open interest increased. This is long build up in call of 17,500. Long build up in call is bullish. Short build up for at the money put is also bullish. Both sides of option chain is indicating bullishness. There is some more information on both sides. There is heavy open interest in 17,200 put and 17,100 put as well as 17,000 put. All are more than 50,000. All these strikes have short built up because there is increase in open interest and decrease in premiums. There is high volume trading at 17,400 and 350 puts as well, and both these puts have decent open interest. Their open interest increase is also good considering the fact that these are in the money options, and there is short built up for in the money options, in the money puts, because open interest has increased and premiums have decreased. So this is short built up in the money puts or at the money puts. If we check for call side, these options have decrease in open interest. So there is increase in open interest on put side, decrease in premiums on put side, whereas for call side there is increase in open interest which is less than that in put side, but premiums are increasing. This is long built up in call side, short built up in put side. Both are indicating bullishness. This is very bullish sign. People are willing to sell in the money puts, but nobody is selling in the money calls. This is just one example, and we need to practice this analysis on at least 100 option chains at end of the day, and then see what happened next day. This practice will help a lot in getting better with option chain analysis. Historical data is available and one can use that data for study purpose, or else we can do it prospectively as well. Now let's practice this on some option chains and find out what happened next day. We'll use iCharts for this purpose.